Welcome to the Explainer. We all just kind of assume someone is making sure banks don't go wild with our money. But who is it really? Is it the government regulators? Or what if the most powerful watchdog is supposed to be, well, you?
Right. We usually picture these government agencies, keeping banks on a tight leash. But there's this other really powerful idea, a theory, that says the real power lies with the market itself. We're talking customers and investors. The idea is that they should be the real financial watchdogs.
And this theory, it's got a name, market discipline. Now, this isn't just some dusty idea in a textbook. It's a fundamental part of global banking regulation. It's built right into the rules that are supposed to keep banks safe all over the world.
The logic behind it seems pretty simple, right? If a bank starts acting reckless, the market is supposed to step in and punish it. Customers pull their money out, investors dump the stock. And all that pressure is meant to force banks to clean up their act and play it safe, which, in turn, keeps the whole financial system stable.
It's a really neat theory, but let's be honest. The big question is, does it actually work in the real world? Well, a fascinating study decided to put it to the test, and they found the perfect place to do it, the banking system in Latin America.
So the researchers looked at 95 banks across 12 different countries, and they focused on a very specific time frame. 2008 to 2012. Now, just think about that timing for a second. This is right in the chaotic aftermath of the global financial crisis. If there was ever a time for people to be watching their banks like a hawk, this was it.
So how is this whole thing supposed to go down? Well, the theory says this market watchdog has two main ways of enforcing the rules, and both are controlled by a bank's very own customers.
First up, you've got the depositors. That's anyone with a savings account, the everyday customer. And then you've got the borrowers, all the people and all the businesses taking out loans. The whole theory really hinges on both of these groups doing their part to keep risky banks in check.
For depositors, the idea is pretty direct. They have two levers they can pull. First, there's the price lever. They can demand higher interest rates on their savings to make up for the extra risk. Or they can just pull the quantity lever and walk away, taking their money to a safer bank.
And borrowers? They're the other side of that same coin. A stable bank is a reliable partner, right? So in theory, borrowers will either be willing to pay a little extra for a loan from a safe bank, or they'll just take their business somewhere else entirely. Either way, it cuts off risky banks from a huge source of their income.
Okay, but here is where the story takes a really crucial plot twist. What if the signals we think are coming from the market are actually being caused by something else, something happening deep inside the bank itself?
And that question leads us to a concept that completely muddies the waters. The researchers call it the bank's own internal capital market. Okay, so imagine this. A bank suddenly starts offering these amazing high interest rates on its savings accounts. The market discipline theory would scream, "Whoa, red flag, that bank must be really risky." But what if that bank just needs a ton of cash to fund a sudden boom in home loans it wants to give out? See the problem? What looks like a signal of high risk from the outside might just be a sign of high demand on the inside.
So, this is the moment of truth. Once the researchers managed to filter out all that internal noise from the bank's own agendas, what was left? Did they find any real hard evidence of market discipline at work in Latin America?
The results were, well, they were pretty startling. Whether they looked at how depositors behaved or how borrowers behaved, the result was exactly the same. The evidence was weak and inconsistent. There was just no proof that customers were systematically punishing risky banks. The market's watchdog wasn't just being quiet, it was completely asleep on the job.
Now, this is a huge finding. I mean, if it wasn't the customers who were influencing bank behavior, especially during a time of major financial anxiety, then what on earth was?
It turns out the answer had almost nothing to do with how risky any individual bank was. Instead, what really drove bank performance were these huge, big-picture economic forces, things like GDP growth and national interest rates. Basically, a rising economic tide was lifting all the boats, but the risky ones and the safe ones right along with it.
And all of this leads to a powerful and, to be honest, a kind of unsettling conclusion.
The big takeaway from the study is that we can't just assume market discipline is working. I mean, the theory's nice and elegant, but reality, it's messy. The study argues that if we actually want the market to help regulate banks, then policymakers have to find a way to actively wake that sleeping watchdog up.
And that leaves us with this huge, critical question. If the market watchdog is asleep and government bailouts often create a safety net, then who exactly is on guard?
who is really watching the banks?